All right, so stocks faltered a little bit today. More of a loss than what we've seen in a while, but nothing abnormal. And I'm going to take a look at recent precedent and the kind of declines we've had during this bullish run to see if this move is peculiar in its own right versus some of these other moves, and whether or not we should anticipate more of this to turn into something more by the end of this week or not. So we're going to take a look at that. Some of the technical signs that the market is showing right now. We'll take a look at what's driving this price action like we always do, how the sectors performed today, some interesting patterns there, some of the, how the dollar and yields move. Those have been big. They have been big drivers of the market lately, but not driving the way you'd think today. So we'll take a look at that. Like I said, how the sectors perform. Some big name stocks driving a lot of the weakness today, but some others that are performing in the opposite direction. Of course, a dramatic move and reversal in Bitcoin. So we'll take a look at that as well and what that means for broader risk appetite. And then our trade idea is a stock that's not in the technology space, in this AI space. It's actually in more of a consumer staple space and has really been struggling and broke down some more today. And we'll talk about how to trade it. So let's go ahead and get started. Today is Tuesday, March the 5th, 2024. This is the Market Outlook from MarketScholars.com. My name is David Settle. Hey, before we get going too far, I invite you to subscribe to our YouTube channel. This icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these other things over here on the right, including our Market Outlook live video right up here. This is where I take a look at all the trades we've done in prior videos to see whether we should stay in. We got out of a couple today, as well as we put on today's trade idea already before the market closed during that video. Come down to the bottom, click this heart, it opens up this tab, hit that like button there. Same thing there, click the thumbs up icon, it opens up this tab, hit that like button. Again, the more you do that, it helps get our content out to all of our followers on those platforms. So thank you to those who do that day in and day out. Our goal is to get up to 100. So again, thank you. And those who don't do it, you can do it right now while you're watching with 1 or 2 really easy clicks. All right, let's go ahead and start and take a look at the S&P 500 with the market forecast indicator like we always do. And you'll see that a little bit of a decline today. Again, nothing too major. It was, more than 1%, so we had a percent decline. But we've had plenty of percent decline. In fact, if you look at much has been made about how we haven't had a 2% decline on a closing basis since October, right? And that 24% is the biggest number in the last 20 years. I made a big deal about that. So a very, very big move. But what hasn't really been talked about is that we've had plenty of 1% declines, right? In fact, that number is actually the second biggest one. The only one that's bigger than this is the 3-day rally off the COVID low. 3-day rally off the COVID low. That was 17%. So we had almost 16% run without a 1% decline for, a month and a half. Again, the COVID move was 3 days. So this move right here, in the first 3 days after the COVID low, was a 17% gain. And then we had a 3% drop the next day. So we went, obviously much longer than that without a single 1% decline at all on a closing basis until we rallied 16%. So if you were to kind of look across here, you can see that's a huge number. Very, very big number there. But we've had plenty of 1% declines recently since the beginning of the year, right? We've had 1, 2, 3, 4. This is the 5th 1% decline we've had since the beginning of the year in a matter of 2 months. So it's not that big of a deal. The intermediate line is still in the upper reversal zone, still above market sentiment. It's declining, and the market sentiment line is declining. But again, that doesn't really matter if they're above the 80th percentile. So everything is still pretty strongly bullish. From that perspective, the near-term line is dropped, but again, until it drops into the reversal zone, it's really not that big of a concern, especially until, again, we get a bull tag that we don't bounce up off of. And then, of course, your momentum line, it was actually down to pretty low levels, but we came off of the low at the end of the day, and that brought the momentum line back out of the reversal zone. So, that's hardly a strong bearish short-term sentiment decline. Obviously it's down, but that's not down very much at all. Your NASDAQ 100 felt the brunt of the move today. It was almost down 2% itself. But again, look at its short-term sentiment. Again, the near-term line's barely below the chart's midpoint. The momentum line's barely in the reversal zone. So this is by definition a bounce, a bullish intermediate confirmation signal. You would expect that will bounce off of this according to that signal by itself. Of course, no signal is 100%, but if you're just looking at that signal, that would tell us to expect a bounce. Considering that we bounced off all these other moves, that would be a good expectation to have. The Dow Jones Industrial Average, you can see, did get a bull tag today. So it's the only index that did get one. The intermediate line is below the 80th percentile and below its market sentiment line. So that's a little different than all the others. Again, oversold momentum line, near-term line barely below the 40th percentile. So, more than likely there's a good chance we bounce off of this, kind of like this bull tag over here, rather than being a bull tag that turns into the bearish intermediate run. So we'll see, right? This bull tag didn't have an intermediate line below its market sentiment, so there's a little different from that regard. By the time we got this bull tag, the intermediate line was below market sentiment. So we have that kind of working against us. So we'll see. We need to either bounce off of this or follow through, right? You can see it bounces almost immediately when it does, or when it doesn't bounce immediately, that's when it turns into something more bearish. So we'll find out really quickly before the end of this week what that's going to turn into. Then finally, your Russell 2000, you'll notice again is way up above the moving average, not anywhere close to a bull tag. The intermediate line is still in the reversal zone, still above market sentiment. The market sentiment is the lowest for the Russell than for all the other major indexes. And you can see the near-term lines in bearish territory barely, the momentum lines in lower in oversold levels, but not very strong. So again, this would also be considered a bullish intermediate confirmation signal, a pretty good one, like the one that we saw on the other indexes there. So again, we would expect a bounce off of this, especially with again the bull tag too. You would expect that will probably bounce off that bull tag, and so. Considering the move, considering that we've had other 1% declines like this that pretty much only occur over a day, the recent past precedent is to expect that the market will bounce off of this, and we'll follow that expectation until we see something different, until that precedent changes, right? Until the market decides not to be so bullish on these little minor dips. If you take a look at the weekly chart, you'll see that again we are right now with a lower close. That's kind of when you're so bullish like this, that's kind of the first stage to a trend change, is a lower close. A lot of times that can lead to a transition candle or actually be the transition candle itself. So that's something to keep an eye on. We did get a higher high this week. The PPO is still rising, but just barely. And then the size of the candle has gotten pretty small below its at 3-week average. So we're still in convergence mode there. And it's not a bearish, it's not even a transition candle, but if it finishes the week like this, it can definitely lead into a transition candle. We're now no longer having 3 green arrows, so we're back in kind of convergence mode on the S&P and the Qs. The Dow has been that way for the past few days. The Russell still has the 3 green arrows, right? So we're still 3 green arrows there. If you take a look at the 2-line version of the chart, you'll see that we actually tried to get below the 8-day moving average and kind of failed getting below the 8-day moving average there, but we tried. And we've, again, every other time we've gotten below the 8-day, we bounce right back up. So again, until we don't, we'll expect that to be the case again. At some point in time, it won't. It's going to break that 17 with the MACD already below its moving average, and that's when we'll start to, as you can see right here, that's when you start to break down. But as of, until we do, we'll continue to ride this past precedent and continue to ride this strong trend as long as it will take us. It's not going to last forever, but it will take it. We'll ride it as long as it will take us here. The DMI is still relatively positive. The negative indicator is now the highest it's been during this entire bullish run, above 25, which is so crazy that it's above 25, and we're still well above 30 on the positive. Usually, if the negative gets above 25, usually the positive's way below, is easily below 25, if not lower than that. So the fact that it's still way up here is so crazy on there. So still a relatively bullish candle. Of course, the RSI, CCI are still pretty darn bullish themselves. So nothing's changed there. The Ichimoku cloud is, we're below the green line, But again, we still have a very strong mature trend that hasn't broken the zero yet. When it breaks the zero, like it did here, then right here, then that's when, you know, a mature trend can turn into an intermediate pullback. So at some point in time it will, but it hasn't today, and we still have a very strong positive rate of change. So still well above the cloud as well. So no concern there. And then let's see here, the Bollinger Bands. If we take a look at the Bollinger Bands, we are still in the upper half now, not the upper quartile, but the upper half of the Bollinger Band width. It's still declining. The bands are still outside the Keltner channels. We are no longer trading outside, but we're still above the 20, this moving average, exponential moving average. It's in the middle of the bands and the Keltners. So again, we haven't changed, like we haven't even gotten to the lower half yet. And again, that's kind of when things change, and we're still not there. So they're like, there's no market in turmoil. There's no issues going on. We're still okay. You know, we're still in the upper half of the 4-week range. Now, if we break that, you know, it's a different story. But if we did get down to last week's low point, after getting above last week's high point, barely at the end of the day yesterday, gapping down, which I would consider as a common gap, which again increases the likelihood we just bounce right back up here. Which means that gets filled sooner rather than later. But we'll watch to see if we get below that low point and start to fill in this gap. That's when things get a little dicey, right, at that point. But still, that's not an issue yet. You can see we haven't dropped below 70 yet on the green line. We're still, pretty small range there. As you saw, the volume today, or the range today, was above average. The volume was also slightly above average on SPY, 72 million, almost 6 point range. So again, we are at extremes on both those. The volume is an extreme low. It's 20-day average as the 52-week lows. We were down to the 81st percentile before jumping up on the ATR. So I mean, that's a pretty extreme low for that. And then of course the volatility index has also been low. The VVIX, remember, has been really low, below the 80. Now has jumped up to 84. You can see a big jump in the VVIX there. That usually also means the VIX is going to jump up, and it did. It jumped up above the 90% mark again, up towards 15, but it held so far at 15. What that also means is it jumped up towards its 200-day moving average. It got a little bit above it, but you can see the change, right? So it looks like momentum is swinging back up. It doesn't have to be a long move. Usually isn't. Volatility goes up really quickly and then comes down for a longer period of time. As you can see, even the last one here, 2-day rallying volatility that took 2 weeks to unravel. So, again, it's probably not going to go up for every single day for 2 weeks here like it did pretty much to the downside. But it looks like momentum is swinging to the upside for volatility. So remember, this is a seasonal time of year for volatility to rise. We haven't had a big jump in volatility. We had one a little bit earlier here, but we haven't really had one since since the low point, the seasonal low, until now. And you can see we go to about the middle of March. So we are kind of we're still in a seasonally bullish time of year for volatility, and we're still, until we get to that middle of March time frame, kind of in a period of a decline, of a seasonal decline in the S&P. We've so far been able to weather that with a pretty good move to the upside during the first leg of this, but now we're kind of in the second leg, and we'll see if we'll be able to weather it again. All right, now let's take a look at what's driving this price action here, and see again, U.S. equities, have some gains to give up here. So it's not like necessarily we are just barely starting a bullish run. We've had a good 3-month return, and they're the ones that have the most to give up here on a day like today. When I take a look at just today alone, so let's come over here to just today, you can see the Qs are the biggest losers, down 2.2%. Which is interesting, though, is that yields were actually down today. Bonds were up considerably. That's a pretty big drop in yields. Bonds are up quite a bit. So usually that's actually really bullish for equities, and that was not the case today. The dollar was flat. It wasn't up very much. Gold continues its run, right? Gold has now over 5 days? So 1, 2, 3, 4. Let's see here. Let's see. We go to the 28th. Yeah. So pretty much the 28th. And then the rest of this time is up now almost 5% over the last 5 days. Look at the bond move up higher. So These are really your three safe haven asset classes, your three traditional safe haven asset classes: real estate, gold, and long-term bonds. Now, granted, real estate's been acting like a growth stock here lately during the last few years, both to the downside and to the upside. Emerging markets, you can see, we're down, even though the dollar's pretty flat, and commodities are also pretty flat. And you can see equities also went up with gold before dropping, and now they're down over the last few days. But again, that's just today alone, the move that we saw today is pretty significant in U.S. equities, and of course real estate as well. Like I said, it's acting like a growth stock sometimes. Commodities were down. So like commodities down, yields down, the dollar down, that's usually a recipe for bullishness. Not only were we not bullish today, but we really dropped pretty sharply there. If you take a look at the 10-year yield, you can see we've been trying to figure out whether or not we're going to bounce off this 30-day moving average. Boy, we dropped below that. Now, we're still above the 50, so we're not necessarily breaking down, but if we break that 50 now, there's nothing below here because we just broke the 30 and the 200-day. So really important to see what it does here over the next few days. The dollar still is holding on, so the MACD is slightly negative, stochastic, but they look more like they're basing than they are breaking. So we are below moving averages, but not a lot, and we're still kind of right around that 200. And of course, commodities, which have been basing for a while now, they also broke down pretty hard today. Remember, crude oil is the biggest component of that, and it dropped down towards its 200-day, but not again. I mean, you've got some bearish indicators here, but we're not breaking below these average values, and we're still sitting around that 200-day. That 200-day moving average. So, again, nothing has changed other than the fact that, again, like I said, a pretty significant move, but again, only significant to the downside for like the Qs because of how bullish it was to begin with. So we have to keep that in mind there. I mean, you look at, of course, within the Qs, the biggest names within the Qs here, within those top three sectors. Look at Apple getting an oversold cluster. Adobe breaking down again after trying to get going. It's breaking back down again. Tesla has dark pink. I mean, we're talking about Tesla being, hey, let's take that out of the Magnificent Seven. But Apple and Google are both dark pink shading and a red line too. Now, they're not down 24% in 3 months. But, the Apple's down 12% in 3 months. So it's not just a Tesla story. Adobe's down 9.5%. Cisco has got dark pink shading and red line. And so out of these 12 stocks, 1, 2, 3, 4, 5, 5 of them are dark pink shading and a red line, and the 6th is getting a bull tag today on Microsoft, getting that bull tag there. So really, again, you have a very narrow segment inside of a narrow segment of the market that's leading this particular narrow segment. And again, we've seen this before. We've seen when the rest of this complex starts to break down, but NVIDIA and everything kind of related to NVIDIA keeps going. We've seen that it happen at the end of 2021, going into 22. We've seen it through multiple peaks in 2022. It tends to be the last one to keep going before it finally breaks down. If you look at NVIDIA by itself, here, let's go to the DMI so we can see how parabolic the move has been. Again, we've seen this before. We've seen that over there where it had a parabolic move and then it went sideways. But if you look at at the end of 2021, NVIDIA had a really solid move here, very parabolic move. They got this move up higher, and then it faltered, right? And then the whole market faltered, and it faltered there. And so that's not necessarily. And you see again, there's been instances where it did really well during 2022, and then only to falter, and then finally the rest of the market faltered. This is the most parabolic run that it's had, not just on the daily chart. If you look at the weekly chart, you can see again, just how parabolic the move has been there. And again, we're nowhere near it changing. So I'm not saying that we're about to break down here. There's the parabolic run it had going into the end of 2021. This is higher, right? We've had the ADX now is about as high as we saw in some of these other instances here. And we're getting actually lower highs in the ADX as of right now with significantly higher highs here. and then the positive indicator up about 50. This is on a weekly chart, no less. The lower indicator down below, far below 10. So it's still making its run, and it will continue to make its run. But once it's done with its run, then the rest the rest of the broader market will follow, where the other half of the Magnificent Seven right now is going, and that is dark pink, like into intermediate decline. All of these stocks are in their own individual intermediate decline. Apple, I mean, it's been an intermediate decline since that bull tag there at the end of the year. Google is starting its own intermediate decline, intermediate line way down in the reversal zone. Microsoft just barely got the bull tag, right? So, Apple's bull tag turned into an intermediate decline. We would expect at the intermediate line below market sentiment that this one will too. So again, but the broader market won't yet, as long as Nvidia maintains its strong bullish trend that it has right here. All right, let's take a look at our trade idea of the day, and it's on Pepsi. We'll take it. So again, not a technology stock, but you notice it's not doing too well either, and it's actually breaking down. The intermediate line had made a brief run above its market sentiment, broke back down earlier in February, right before expiration, flattened out again, but then now in this bearish near-term run, and then breaking down below lows today, it's struggling. If you look at its weekly chart here, you'll see that it's got we've had lots of transition candles, but pretty bearish candle here today, or this week, excuse me, as the PPO had gotten less negative, is now turning back down after, golden cross environment for a long time, and now in this death cross environment here. If you look at the 3 green arrows chart, pull up the 3 green arrow chart. So not surprising to see 3 red arrows right now. Looking at the full year, you can see the 3 red arrows with the red line. Pretty decent volume today to help kind of confirm this move to the downside. If you look at the 2-line version of this chart, you can see we are below the 50, below the 200, below the point of control, breaking below the value area. So really kind of breaking down. If you look at the weekly chart, we are flirting with breaking into bear market territory, right below the 200-week moving average. MACD and stochastics breaking down below their moving averages as it kind of moves into a gap of volume here. So it's kind of dangerous territory for the stock. If you look at the DMI, we've got bearish patterns above 25, below 20 down there. The ADX just starting to rise. Looking at the RSI and the CCI, you can see they are also at bearish levels, below 40 for the first time really during most of this move, and then now below minus 150 down there. We are below the Ichimoku cloud. You can see we're below the cloud there. Then we got the beginning of an intermediate trend strength bearish move. They don't tend to last very long, the bearish ones, as you'll see, and they don't get up to 20 like the positive moves to the upside. And then if you look at the Bollinger Bands and the Keltner channels, we are not outside the lower band, but we're pretty darn close, pushing against the bottom band as the bandwidth is increasing, almost to the point of increasing outside the Keltner channels with some increasingly bearish momentum. So we're, it's moving lower, but you saw that, we got that 200-day moving average there. So what we decided to do here is to do a bear call spread, selling the 165 call, buying the 170. So as long as it stays below 165, it doesn't matter how much further it goes down. We can try to get at least about a $500 reward for that normal $1,000 of risk that we put on this trade. So, and like I said, if it were to get back up, if you were to put that break even, the break even is, what we got $1.65. I think if that's right, $1.65 is our credit. You add that to $1.65, so that's at 166.75 is where our break even is. So it's kind of right in this area. So we have to like completely reverse this kind of breakdown below last week's low and get back up above this 165 high, in which case we wouldn't be as bearish anymore, and we're more than willing to take a loss at that point. In that case, ideally no more than $495 loss, since that's the maximum gain that we're trying to accomplish on the trade. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread. And let's keep this conversation going in between videos. Again, thank you very much for watching. Remember, subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at marketscholars.com for free. Follow and like me on Twitter and Facebook as well. Have a great rest of your Tuesday night, everybody, and we'll see you all next time.